Why do the prices of things change? Why does the price of fuel sometimes rise dramatically? Why do concert tickets sell out instantly and then appear online at much higher prices? The answer lies in one of the most important ideas in economics: supply and demand. In any market, there are two sides. Demand comes from consumers, people who want to buy a product or service. Supply comes from producers, businesses that are willing to sell that product or service. Demand usually follows a simple rule. When the price of something falls, people tend to buy more of it. When the price rises, people tend to buy less. Economists call this relationship the law of demand. Supply works in the opposite direction. When prices rise, producers are usually willing to supply more. Higher prices make production more profitable. This relationship is known as the law of supply. In markets, supply and demand interact. Where the quantity that consumers want to buy equals the quantity producers want to sell, we reach something called market equilibrium. The price at this point is known as the equilibrium price. Markets are constantly moving towards this balance. If demand suddenly increases, perhaps because a product becomes more popular, prices tend to rise. Higher prices encourage producers to supply more. Eventually, the market moves towards a new equilibrium. If demand falls, prices tend to drop. Lower prices discourage production and encourage more buying until the market balances again. So supply and demand work together to determine prices and quantities in a market economy. So let's quickly recap. Demand represents consumers' willingness to buy. Supply represents producers' willingness to sell. And the interaction between supply and demand determines the equilibrium price and quantity in a market. Understanding supply and demand is one of the most fundamental concepts in economics. In the next video, we'll look at something closely related: elasticity, which explains how strongly demand or supply responds when prices change.